All right, welcome back to 0.5%. This is episode 12, part 2. I was just on my soapbox talking about how I think this NASDAQ correction that's on its way might be, as referred to here, as jawboning. Trump's putting in all these tariffs, and it's making people nervous, and maybe he's going to be serious about it because he did do tariffs in his last presidency, but maybe some of them are just too extreme, and just by signaling it, they can fix inflation a little bit, they can fix the markets a little bit, and then pull back. So after that, less commonly used fiscal policy, when you go into talk about rationing like in World War II and stuff, I don't think we're like that right now. Next question I asked was, historically, which U.S. presidents raised tariffs on U.S. imports the most? That might be redundant, but these are the answers that I got. So first was Herbert Hoover in 1929 to 1933. It was the Smoot-Hawley Tariff Act of 1930. Massive tariff hikes on over 20,000 imported goods, one of the largest in U.S. history. Average tariffs jumped to around 60%. These were aimed to protect U.S. farmers and manufacturers during the Great Depression. Noted that it backfired, sparked a global trade war, and worsened the Depression. The result? Retaliatory tariffs from over 25 countries, collapsing global trade. So I think that's what everybody's worried about right now. I've heard this trade war, like all on the news. Let's go and see some of the other examples. We have Donald Trump from 2017 to 2021. Launched a sweeping trade war, primarily targeting China, but also Europe, Canada, Mexico. And he imposed tariffs on steel and aluminum, over $350 billion worth of Chinese imports, washing machines, solar panels, and more. The goals were to address trade imbalances, protect U.S. manufacturing, put pressure on China on IP theft, and forced tech transfers. It says the impact, global trade tensions, increased input costs. U.S. businesses and consumers shouldered much of the cost. Then we have William McKinley in 1897 to 1901. So when we're in the 1800s, I think things were probably just regardless going to act different to tariffs than they do nowadays. So William McKinley raised average duties to almost, is that right? Average duties, I don't know the vocabulary on that, to almost 50%. Strong protectionist platform, advocated for U.S. industry. Protectionism was dominant Republican theme. Ulysses Grant continued post-Civil War high tariffs, especially to protect northern industries. Tariff rates were already elevated from the war and stayed high for decades. So I asked a question about when the stock market opened because I was curious about these tariffs in the 1800s. So it says here the New York Stock Exchange opened in 1792. These tariffs went in 1870 and 1890s. And then I was just looking at how far back I could go. And it stops here, which is, does it say the year? I don't know, like 1999. So I wanted to see when these time periods were and when they hit the chart. So we can do a couple. Let's see, Hoover was the 1930. I guess we can just do Trump. So 2017 to 2021. Let's take a look. (2017 to 2021). Is that what it said? Yeah, 2017 to 2021. So, man, that's kind of crazy. With whatever tariffs he put in, as volatile as the NASDAQ is, as hard as I think tech would be impacted by putting tariffs on China and maybe like Taiwan and stuff like that, from 2017 to 2021, it was ripping. And there is that post-COVID dip in there. So I think, Trump had to, he had to stimulate the market somehow. But yeah, all this was unnatural, and it's still been doing it. Like, this is crazy. Look before, how the size of these candlesticks and how gradual it is. And then in 2018, it just exploded. So, yeah, maybe this is the future and growth is just exponential, but it does need to breathe. It can't just rip. So, we had this one in 2019, had this one in 2020, we had another one mid-2022. And I think, did we already get into that? I've been ripping through all this. Let's see. Yeah, so the one in 2022 was the Federal Reserve interest rates. That's what it was. So that's this one. And then we're going to get another one here. I believe. I guess twice it's come down to the 50 or the 20 moving average and not touched the 50. But it's already passed it quite a bit. And it pulled back on those. You can see the stem. So I think it's going to keep coming down. 381. But back to the question. So where was it? Right. We said primary catalyst for the NASDAQ drop, and then which presidents raised tariffs, and then where are we at? So I asked in general, what was the result of each president that raised tariffs? William McKinley in 1890, the tariff was designed to protect U.S. industries but led to increased consumer prices. Political consequences, the tariff's unpopularity contributed to a significant Republican loss in the 1890 midterm elections, with Democrats gaining and commanding majority in the House. Herbert Hoover in 1930, the outcome: international retaliation. Over 25 countries responded with their own tariffs, leading to a significant decline in global trade. Economic impact: U.S. imports and exports fell by about 2/3 between 1929 and 1932, exacerbating the Great Depression. Donald Trump. Outcomes: economic impact. Tariffs led to increased costs in U.S. business and consumers, contributing to market volatility and economic slowdown. The international relations provoked retaliatory measures from affected countries, straining trade relationships. The domestic response faced criticism from economists and business leaders who argued that the tariffs were economically harmful and based on flawed logic. So I followed up then with, during these presidential years of increased tariffs, which U.S. market sectors thrived and grew profitable? In the William McKinley era, it was industrial manufacturing, consumer goods, apparel, and railroads. Excuse me. I think I'm going to have to cut that out, so I'm going to start that over. So I said, during these presidential years of increased tariffs, which U.S. market sectors thrived and grew profitable? In William McKinley era, 1890s, it was industrial manufacturing, consumer goods and apparel, and railroads. I don't think that's going to be the case in 2 out of 3 here. Industrial, I think that'll do great. We're going to start producing more steel and whatever in the U.S. But we get a huge, actually I got to think about it. So my first thought on consumer goods and apparel is, like, Nike, for example, gets all of its stuff done in China. Like, that's going to make those type of businesses hurt. Railroads. We're not building any more railroads. So for industrials, if we're sticking to America, the ones that are going to do well are the ones that are mining here, the ones that are drilling here. That's my first thoughts. So Herbert Hoover, agriculture did well. I could see that as well for the U.S. Unless agriculture is heavily dependent on like fertilizers and stuff or chemicals from other countries, then I could see something happening that would hurt them. Textiles and light manufacturing. So in Donald Trump's era, steel and aluminum producers, stocks like U.S. Steel, Alcoa, got a short-term boost from reduced foreign competition. Some domestic industrials and pharmaceuticals, largely insulated from the tariffs. So the pharmaceuticals were insulated last time. Weren't affected, and they continued to rip. I think they had to be insulated, though, because of COVID. Yeah, I don't know if that's a weird tie together. I don't know if it was because of COVID or if it was because it was free. It's weird. Anyways. Manufacturers was mixed outcomes, in realtors and tech. Hurt by higher prices and supply chain distributions, Apple and Walmart. All right, so I wanted to see a chart showing the sector performance. So here it is. During Trump's time, utilities did the best at 18%. Steel and metals. Next was real estate at 16%. Steel and metals at 15%. Pharmaceuticals at 12%. Technology at 5%. What got hurt the most was automotive, industrials, and retail. So I said, from utilities, which ETF of the sector has the most indicators to perform well based on this estimated performance? And it recommended XLU. Based on the estimated performance of the utility sector, ticker XLU, it stands out as a leading ETF in this category. In 2024, XLU achieved a nearly 30% return, surpassing broader market gains of approximately 22%. Key features of XLU, they hold companies such as NextEra Energy, Duke Energy, and Dominion Energy. They have a dividend yield, offers an attractive dividend of about 2.51%. That's always great. Expense ratio maintains a low expense ratio of 0.09. So the next question I followed up with was phrased poorly, but what I was trying to say was, based on Trump's past presidency and the sectors that perform well during eras of increased tariffs, which sector ETF has the most indicators to perform best for the next 4 years? And it gave me materials and industrials, it thinks, defensive sectors. But let me tell you the reason why. It says, based on historical trends during periods of increased tariffs, such as during President Trump's term, sectors that benefited the most tend to be those focused on domestic production and raw materials. For example, materials and industrials and defense sectors. Two commonly tracked sector ETFs that capture these trends are XLB and XLI. So we've got 3 of them now: XLI, XLB, and the previous one it mentioned was XLU. I have XLB pulled up here and XLI pulled up here. Let's see, what was it year-wise? Let's just look around 2020 during COVID, how these did. Bring it back to 2022, 2020. I mean, they fell like the rest of it, or the rest of the market. What I'm going to do is I'm going to put these on barchart.com and compare them there. But this is the approach I'm taking to try to understand what's going on with the tariffs, what's going on with the market right now, and maybe what to expect. But let's see. Is there any more of the ChatGPT I want to discuss in here? Nope. So, yeah, XLB and XLI was what ChatGPT is. I mean, it's not. I'm not giving financial advice. ChatGPT is not giving financial advice. It's just telling me based on the past. These two have indicators that they might do well while Trump's president again and doing tariffs again. All right, well, I think we're coming up to the end of part 2. I've got a few more things I want to jump into about ETFs, and then I want to do a part on crypto. So I'll see y'all there.